let's quickly look at Regulation 5.1F. That one is straightforward. Regulation 5.1F, do you know it? Income and expenditure account. Income and expenditure account. Here we deal with the income after date of death and the expenditure after date of death. What type of income can we find in an estate? The interests on the investment, not so. Interests after date of death. I'm writing it like this so that you don't forget. What else? If there are dividends declared after date of death. Dividends, let me write it in full so that it makes sense. Declared after date of death. It means that dividends declared before date of death will not come here, will go to your liquidation account. Ne?
Rental.
Expenditure will be your executor's fees. At what rate? At 6% on what? On the income, total income. If the fact says the executor was registered for VAT, that is when we'll also include VAT. Ne? So these are the basics of your income and expenditure account. Now from the amount of the income, let's say here we said that the interest was how much? 5,000. There are no dividends declared, so it's 0. So therefore, our income is 5,000. Executor's fee at 6% on 5,000 is how much? 300. The executor is not registered for VAT, or do you want us to register the executor for VAT?
No.
Oh, okay. Okay, but let's do that for the purpose of our example. Then, let's say the executor is registered for VAT. Therefore, it will be VAT at 15% on the executor's fee.
Yes.
Ne? In other words, VAT 15% on 300, which will be 45. Therefore, 5,000 minus 300 minus 45, then we have the balance, which is how much? 4655. You can also state who's going to get this balance. If we have only one beneficiary, I mean, it's nice to say balance to be paid to the surviving spouse or to the heir. Are we together? Yes. So this is the income and expenditure account. Let's correct the mistake of some of us who thought that the executor's fee is 3.5%. This time around is 6%. It's not my decision. It's per the tariff. The tariff that we get from the regulation. Which regulation? Regulation 8. Ne? Tells us that tariff for executor's fee after date of death is 6%, not 3.5%. Ne? Is this easy? Okay. Can we move to Regulation 5.1G? What is it? The fiduciary assets account. That is Regulation 5.1G. What are we dealing with here? What type of assets are we going to to reflect here. This is that account that we call an account within an account. Why do we say so? Here we're going to have a situation where the deceased was a fiduciary. He was a fiduciary where he was enjoying the rights over property. And how did the deceased become a fiduciary? The deceased became a fiduciary in terms of the will of A. A created in his will what we call a fidecommissum. Remember what it is, ne? Yeah. We dealt with that in module 1. Ne? A fidecommissum where A in his will leaves his property to B. So that when B dies, that property must go to C. We call this a fidecommissum. Now, when A dies, that property will go to B. Ne? Now, when we are dealing with the estate of A, where will we reflect this property? In the under assets. Who says no? We are going to reflect it in A's liquidation account because this property belongs to A. A has full ownership. That is why A can make a will and dispose of this asset because it belongs to him. Now he leaves it to B with the condition that when B dies, it must move on to C. Yeah? From the estate of A, it went to B. When B dies, where will we reflect this asset? Fiduciary asset account. Ne? We'll come back to that. But then it moves on to C. Ne? It moves to C in terms of the will of A. When C dies, where are we going to reflect that property when we deal with his liquidation account? In the liquidation account or in the fiduciary asset account? When C dies. C. Liquidation account. Why? Because C now has full ownership of that asset. Is it making sense? Now, with Regulation 5.1G, it means that we are dealing with a situation where B has died. We are dealing now with the estate of B. We don't reflect this asset in his liquidation account because B does not have full ownership of this asset. B cannot create a will and dispose this asset as he wish. Ne? He was only holding it as a fiduciary. That is why we call this a fiduciary assets account. Also in assignment number 4. Ne? So now we are correcting that an asset that is a fiduciary asset must not be reflected in the liquidation account. It will be reflected under the fiduciary assets account. Yeah? That is why we are here to rectify those. Yeah. No? Don't feel bad about it. Yeah? It was before you came to this workshop, so don't worry. Yeah? Yeah, we are correcting that. So if it comes in the exam, you are not going to repeat that mistake. Not so. Yes. Therefore, here we are dealing with the asset that was held by B as a fiduciary. Now, we must fully account on this asset as required by Regulation 5.1G. And how do we do that? And why do we call it an account within an account? Because we must have a liquidation account on this asset. Ne? and we're going to make it more practical and say, on this asset, we're going to have what we call a liquidation account. And on our liquidation account, obviously, we're going to start with what? Assets. Not so. Start paying assets. And then we're going to come to what? Immovable property. That is why we call it an account within an account. And on immovable property, we are going to describe this immovable property according to the title deed description. Why? Because Regulation 5.1G Roman figure 1 says so. Ne? So Regulation 5.1G Roman figure 1 tells us the same information as Regulation 5.1C Roman figure 1. Do you see that? So we are going to describe it in full, provide its value. Are we going to provide a divestment note in terms of what?
In terms of the word of I.
Regulation 5.1G Roman figure 2 says this asset must have a divestment note. That is Regulation 5.1G Roman figure 2. But read that regulation carefully. It says in your divestment note, you must indicate how was the fideicommissium created. It's different from Regulation 5.1C Roman figure 5. Regulation 5.1G Roman figure 2 tells you exactly what must go into that divestment note. Says how was the fideicommissium created? So it was created in the will of A, who has since died on this particular day. Ne? And whose estate was reported to the Master of the High Court, Pretoria or Bloemfontein or Cape Town. You must provide also the estate number. Estate number, yes. You must mention the master's reference number. Ne? So that is the requirement of Regulation 5.1G Roman figure 2 on your divestment note. Ne? The value will be given to you in the set of facts. Obvious. Ne? And once we have dealt with that, then we are going to deal with what? The liabilities.
I'm sorry, before you
Yes.
The value that we put in for the immovable property, is it as a date of death for A or the value now when B dies?
Good question. Which value are we putting here? Is it the value when A died or when B died? Is the value when B died? That value, let's say, is 148,000 when B died. Are we together? Yeah. Then we're going to deal with the liabilities, not the liabilities of the entire liquidation and district. No, the liabilities only with regard to the fiduciary asset. Are we together? Okay. So, what will be the liabilities of the fiduciary asset? Isn't it that this 148,000, we obtain it after requesting for valuation of this asset as date of death? So there will be valuation costs. Can you see? Valuation costs. What else can be a liability? This property must be transferred to who? To C. So there will be transfer costs. Transfer costs. Aha, we have here the executor's fee. Is the executor entitled to a fee on this asset?
Yes.
You are not working for Mahala. Yeah. You must be paid. Yes. At what rate? 6%. 3.5%. Ne? Yes. Executor's fee add 3.5% on your total assets. Not so. If the executor is registered for VAT, we are going to add VAT on the executor's fee.
Sorry, another question. You said you are transferring this property to C.
To C.
Yes.
Do we then not transfer this property to B, and then when he dies, we transfer?
But he is there.
That's-
We deal with B.
Sorry, stupid question.
No, that's not a good question. Are you fine?
Okay, so from A we transfer to B.
To B.
And then he
Okay,
died.
okay.
Ne?
Yeah.
Now we are dealing with the estate of B.
B.
Ne? So because B has died, this property is going to move to C, but in terms of the will of A. Yes. That is why we emphasize the point that B, although the property is registered in his name, but he does not have full ownership to can transfer it to any other person. Ne? He's only holding it as a fiduciary. Ne? Yeah. It's different from a usufruct. Ne? Okay. So far, are we covered? Okay. So from the assets, we're going to pay for the liabilities, and the balance goes to C. Ne? The balance available for distribution will move on to C. So if there is cash in the estate, this account will also have a recapitulation statement. Are we together? On a fiduciary. So it will be a recap on what? On the fiduciary assets account. And we deal it the same way that we have dealt in terms of Regulation 5.1D. So that will be the cash on the fiduciary asset minus the liabilities of the fiduciary asset. And the balance that is left will go to C, because now it's going to get the property, not so. Okay. Then we're going to have what? The distribution account. On what? On the fiduciary assets account. On the distribution account, we are going to follow the same principles that were given to us by Regulation 5.1E. We are going to reflect the balance available for distribution in the fiduciary asset. We are going to say, therefore, it is awarded to, and give the full name of C, and state whether C is a major or a minor. And then state that C is getting this property in terms of the will of A, not B. Ne? Yes. And that the award consists of this immovable property and cash. If there's a shortfall, then we state that C will contribute the shortfall into the estate, because we have dealt with the recapitulation statement. We know whether there is a surplus or a shortfall. If it's possible, there is cash after the date of death, then we're also going to have what? Income and expenditure account on the fiduciary asset account. That is why we call it an account within an account. Are we together? So we are giving a full account on the fiduciary asset. Any question regarding Regulation 5.1G? Do you want it in the exam? No. Are you sure you don't want it? No. Okay. Noted. Ne? Noted.
So we're not going to have it.
No, it's noted. You know what? What I like about these things, we know how to deal with them because already we have dealt with them in the assignments. That is the purpose of those assignments, to know how to deal with it. Now, we are only clarifying some of the small things. Ne? We don't give you the exam for you to fail. No. That is not our purpose. We want you to have sufficient information regarding the subject matter so that when you advise clients, you give them the correct advice. We want you to have to possess the necessary skills to deal with these matters. It is not our purpose for you to fail. Ne? That's all. But now you have shown understanding on how to deal with the fiduciary asset account, and now you understand why do we call it an account within an account. And we have just said, we have noted that you don't desire it to be in the main exam. It's noted, ne?
Thank you.
Okay. Estate duty addendum, ne? This is regulation 51H. Estate duty account, ne? Now this is that part in the estate where we have to calculate if there is estate duty payable by the estate. Ne? So all this time we've been using the administration of estate primarily to determine what? The distributable estate to the beneficiaries. But when we come to regulation 51H, we want to see if there is a dutiable amount in this estate. And here, to calculate that amount will be guided by another piece of legislation, which is what? The Estate Duty Act. Ne? So we want to see whether this estate is liable for tax or not. This tax of the estate, we call it estate duty. And we are guided by the Estate Duty Act. Now let's look what the Estate Duty Act tells us. How must we determine whether there is estate duty payable by the estate? Ne? The Estate Duty Act says estate duty is payable on the assets of the deceased as at the date of death. Don't forget that part. Estate duty is payable on the estate of the deceased as at the date of death, and is payable on the dutiable amount. Are we together? Mm-hmm. So what does it suggest? It suggests that we must determine the dutiable amount so that we can know how much estate duty is payable to SARS. Remember, one of the interested parties here is SARS. Yeah. Are we together? Yes. Now, how are we going to determine the dutiable amount? How do we determine that? The Estate Duty Act says determine the dutiable amount using the provisions of the Act. Ne? So, this suggests that whatever we do, we are guided by the Act. Because the Act itself said, use my provision to determine the dutiable amount. Now we realize that there is a formula that we can use that contains the provisions of the Act. We call it a general formula. Ne? This general formula, I call it a skeleton because if it's a skeleton, it means that we'll provide meat into the skeleton. The meat will get it from the set of facts. Not so. Now let us look at this skeleton, this general formula. Ne? The Estate Duty Act firstly tells us that we must know what is referred to as actual property of the deceased. Ne? We must know what is actual property of the deceased. That is number one. The Estate Duty Act says we must know what is deemed property. Are we together? Mm-hmm. The Estate Duty Act tells us that once we know what is actual property and what is deemed property, we must add the two together for us to arrive at what it calls the gross value. The gross value of the estate. Are we together? The Estate Duty Act says, once you know what is the gross value, you must take into account what? Allowable deductions. Ne? These are deducted from where? From the gross value, for us to arrive at the net value. Not so. Okay. Now, estate duty is not payable on the gross value. Estate duty is not payable on the net value. Estate duty is payable on the dutiable amount. We have not yet arrived there. Now, the Estate Duty Act is so kind, ladies and gentlemen, as to give us a discount. Ne? It calls this discount a primary rebate. It says minus the primary rebate from the net value. So we are going to less a primary rebate from the net value for us to arrive at the dutiable amount, for us to arrive at the taxable amount. Dutiable amount. Once we know the dutiable amount, then we are going to use the percentage that is given to us in the schedule, ne? To determine what? We have to determine actual duty payable. Actual duty payable. Payable where? Where is it actual duty payable to? SARS. Ne?
Yeah.
So this is the skeleton. This is the formula that we are going to use, ne? To arrive at the dutiable amount, at the taxable amount. Then we'll know, when we use the percentages, we'll come to the percentages. How much actual duty is payable to SARS. Any questions so far? Now remember what the estate duty said. The estate duty said, use the provisions of the Act to arrive at this dutiable amount. Not so. Your next question will be what? What is actual property? What is actual property, ladies and gentlemen?
Total assets.
Ah.
Total assets.
Actual property is what the Estate Duty Act says is actual property. Yeah. Remember, the Estate Duty Act says use my provision to calculate the dutiable amount. It means it's going to tell us what to do, how to arrive there. Ne? Yeah. So we are not estate duty ourselves. Ne? We have to listen to what the Estate Duty Act says is actual property. And the Estate Duty Act tells us what is actual property under section 3 in brackets 2. Ne? So don't scratch your head to find out what is actual property. No. You look at the act itself. Ne? The next question is, what is deemed property? Deemed property is what the Estate Duty Act says is deemed property under section 3 in brackets 3. Ne? Then we're going to add your subtotal of section 3.2 and your subtotal of section 3.3 to arrive at the gross value. Easy. Now, it is the Estate Duty Act that tells us that for us to arrive at the net value, there are certain items that must be deducted from the gross value. For us to arrive at the net value, there are certain items that must be deducted from the gross value. Which are those items? Don't worry. The Estate Duty Act will tell us which ones are those. There? Those are the ones that are provided under section 4 of the Estate Duty Act. Are we together? Yeah. So we are going to look at them and deduct them from the gross value, then we arrive at a net value. Now the Estate Duty Act says that you must also deduct a primary rebate. Where does it tell us that we must deduct a primary rebate? Aha. The Estate Duty Act under section 4, capital A, tells us that we must deduct a primary rebate. We deduct a primary rebate from the net value, then we arrive at the dutiable amount. So we have arrived there using the provisions of the Act all the way. Can you see? That is what the Estate Duty Act says we should do. Ne? Simple. Easy. Now, the next question that we're going to ask ourselves is what? Under actual property, what does section 3.2 says is actual property? Ne? Now we look at section 3 in brackets 2. And when we look at it, it tells us that the total assets as per the liquidation account is actual property. We go back to the liquidation account. This total assets, we are going to carry them forward to the estate duty addendum because they are called there by section 3.2. So therefore, your total assets as per the liquidation account. It's actual property. Yeah? Is there anything else under section 3.2 that tells us that it is actual property? Yes. And which one is that? The limited interest that were enjoyed by the deceased. Yeah? Those limited interests, some of them we have reflected them where? Under regulation 5.1G, under the fiduciary assets account. So the limited interests that were enjoyed by the deceased. For an example, those that we have reflected under regulation 5.1G, the fiduciary assets, are actual property. It's not me who says that. It's the Estate Duty Act. Are we together? Yeah. The Estate Duty Act tells us under section 3.2 what it regards as deemed property. And it tells us that life policy is deemed property. Ne? If the deceased was married out of community of property with the accrual system, and there is an accrual claim in favor of the estate, the Estate Duty Act tells us that that matrimonial accrual claim for the purpose of estate duty is deemed property. It is not up to you to decide. It is the Estate Duty Act that tells us what must come under deemed property. And for our purpose, we only want to stick to these two. Are we together? Yes. Any questions so far?
Just clarify the accrual system. Is it the deceased claiming on the spouse or the spouse claiming on the deceased?
It is a claim in favor of the estate. Yes. Now, yes, ma'am.
Assets outside the Republic, are they in property?
Yeah, actual property. Yes. If, yes, are you fine? Good. Now, when you look at the nature of deemed property, what do you see there? Policies that have matured and the matrimonial accrual claim. And when you look at them, you remember that general statement that we made at the beginning, which says what? Estate duty is payable on the assets of the deceased as at the date of death. But here you have a life policy and a matrimonial accrual claim. These are the assets that gain value as a result of the death of the deceased. Can you see that? Yeah. So, by the nature of that general statement, it means that they will not be dutiable. Can you see that? There comes the word, deemed property. The Estate Duty Act under Section 3.3 says, I'm aware that these two gain value as a result of the death of the deceased. In other words, they come after the date of death. But I deem them to be the assets of the deceased as at the date of death, so that there must be text. That is why we call them deemed property. That is why we separate actual property and deemed property. Are we together? Does it make sense? Where does the word deemed property come from? And it will make easy that under deemed property, for our purpose, don't include anything else except for a life policy or matrimonial accrual claim. No shares here. I know the word shares sound nicer under deemed property. It's not deemed property because Section 3.3 says nothing with regard to shares under deemed property. Are we together? Yes. Yes, ma'am.
Hi, Adam. Life policy, is it the policy that paid straight to the beneficiary or?
All those policies, they are deemed property. Yeah? I'll come back to that question again. Yeah. I'll address it in full. Remember, we are taking it step by step. We want to remove this myth that this calculation is difficult. You must see that this is very easy. This is straightforward. But we are taking it step by step. Ne? So under deemed property, these ones you are going to reflect. Under actual property, only the assets as per the liquidation account and the limited interest. Are we together? Yes. Okay.
Did we ask the question whether is the policies payable, beneficiary payable to the estate? So all of them.
Yeah, we'll say.
Oh,
Yeah.
okay.
Now, what we know at the present moment is that a policy of the deceased is deemed property. Nah? Okay. Now, the challenge in the calculation of estate duty, ladies and gentlemen, is to arrive at the gross value. You'll see later from the allowable deductions up to the end, it's straightforward, it's very easy. Now let us deal with this part. If we polish this part, you'll see everything will become very smooth. Are we together? Okay. Now let us deal with this part firstly. Actual property. Or do you want to deal with deemed property first? Actual property. Okay. Let's come here. We are dealing with actual property. We said under actual property, we are going to, section 3.2 says there are the total assets as per the liquidation account. Now, here, ladies and gentlemen, we said we carry forward the amount from the liquidation account. Ne? So this will be our number one under actual property. Remember, under actual property, our number one will be those total assets. Number two, limited interest. We'll come to the limited interest. Let us deal with our total assets first. We are going to make an adjustment under our total assets in order to do what? To comply with the Estate Duty Act. And how do we do that? It is possible. Let's assume for a moment that our total assets as per the liquidation account gave us the amount of 500,000 for a moment. So we must make an adjustment with regard to that amount, ne? In compliance with the Estate Duty Act. The first one is there a possibility that included in this 500,000 as per the liquidation account, we can find an item that is regarded by the Estate Duty Act as being deemed property, which is not supposed to be under the subheading actual property? Is there that possibility? Yes. The answer is yes. Which policy is that one? Exactly. That policy that did not nominate a beneficiary, that you have included under claims in favor of the estate, it formed part of the 500,000. Let's assume that the proceeds of that policy was 40,000 for a moment. I like to use small figures so that we are not overwhelmed by these huge numbers. So that policy that was paid into the estate is 40,000. It finds itself by default under subheading actual property. Now, in compliance with the Estate Duty Act, we must remove it from the subheading actual property and take it to the subheading deemed property. How are we going to do that? Because we are dealing with an account, we speak the language of accounting. With less. Ne? We are going to less policy. Let's call it policy A. Policy A that was payable into the estate in the amount of, we said how much? 40,000, ne? 40,000. Those are the total proceeds. What do we do with it? We are going to take it to deemed property. So we add it to deemed property. So we say we are going to add what? Policy A in the amount of 40,000. So under actual property, if you like, you reflect it on the debit side. But under deemed property, then you can reflect it under credit side. Are we together? Are we fine so far? What about that policy that was payable directly to a beneficiary? That was a question. How do we deal with it? Are we going to subtract it from actual property? No. Why not? Exactly. It never formed part of your total assets as per the liquidation account. But then we know that in terms of section 3.3, it is deemed property. Ne? So therefore that policy will be reflected where? Under deemed property. Let's call that policy policy B. We'll make that B to stand for beneficiary. It's a policy that was payable directly to a beneficiary. Let's assume for a moment that that policy, the proceeds were 30,000. So we'll put 30,000 here. So the difference between policy A and policy B is that policy A was deducted from the total assets because it did not nominate a beneficiary. But then that policy, we know that it belongs under deemed property for the purpose of estate duty. Policy B was not deducted from actual property because it never formed part of the estate. It was never under the subheading actual property by default. That is why it goes straight to deemed property. In the examination, for showing your understanding of this subject matter, when you take out policy A from actual property, we give you a mark for that. And you take it to deemed property, you know your story, we give you a mark for that. Are we together? Because you are doing what? You are complying with the Estate Duty Act. For showing us that you know that a policy is deemed property, even if it did not form part of the liquidation account, but it is dutiable, we give you a mark for that. There's no way where you can get set of facts where we don't have a policy A or a policy B. So tell me, how can you fail this thing? Because you know, with regard to policies, how you deal with them. Something that you must remember is that here, we only deal with policies that are matured. Let's address that. A policy that has been surrendered is not deemed property. It remains an asset in the deceased estate. It remains there. It's fine. Here, policies that we are referring to are those that have matured only. They were on the life of the deceased and the deceased has died. Matured policies. Please don't adjust policies that have been surrendered. If you want to do that, then we are going to mark you wrong. Because you are arguing with the Estate Duty Act. And we are going to protect the Estate Duty Act. Yes. Any question with regard to policies? We'll add something later, but at least have an idea what we're talking about. If there was a matrimonial accrual claim in favor of the estate, will it have formed part of your total assets as per the liquidation account?
Yes.
You will have reflected it where? Under claims in favor of the estate. But when you come to the calculation of estate duty, you are told by section 3.3 that a matrimonial accrual claim is regarded as deemed property. So what must you do in compliance with the Estate Duty Act, just like what you did with that policy A? You'll deal with it the same way. You'll less the matrimonial accrual claim, let's say it's for 10,000. 10,000 from actual property, and you are going to add it under deemed property in the amount of 10,000. In the exam, wait for us and see what we'll do to that. What will we do? We give you a mark for that, and we give you a mark for that. You know, when you go to the exam with this vision of this thing, you'll never fail. You'll remember where was the mark allocated there. Are we together? Okay. Any questions so far? Straightforward. You see it's coming. Ne? Yeah, bit by bit. Ne? Okay. Let us look under actual property. What is the estate duty saying again with regard to the values? Let's deal with shares in a private company. Ne? Shares in a private company are dutiable at their market value. Who says so? The Estate Duty Act. Ne? So, shares in a private company, in other words, shares Pty Ltd, are dutiable at their market value as provided to us by section 51F bis. So we don't do as we please. We are guided by the Act. Now, section 51F bis deals with shares in a private company owned, not public company. It says those shares are dutiable at their market value. Why do we have to adjust here? If the set of facts says the shares were valued at 60,000 and were sold for 70,000, as an example, In the liquidation account, we've reflected them at the selling price, not so. In other words, included in this 500,000 is the selling price of the shares Pty Ltd at 70,000. Why did we include the selling price in the liquidation account? We remember the general principle there. An asset of the deceased that is sold during the course of liquidation must be reflected at its selling price. That is why there we reflected the selling price. But when we come to the estate duty calculation, the estate duty excess, they are not dutiable at the selling price. They are dutiable at the market value. And the market value is how much? 60,000. But they were sold for 70,000. Therefore, what must we do to arrive at the market value? Subtract the difference between the selling price and the market value. Therefore, with regard to shares in a private company, you must get the difference. You must get the difference between the market value and the selling price. Because the selling price is higher than the market value, and we want to come to a lesser market value. That is why we subtract. If the market value was higher than the selling price, then we're going to add the difference in compliance with section 5.1 FBs. Are we together, ladies and gentlemen? So it's not always the case that when we see shares in a private company, we say, minus, subtract. You must look whether the market value is it higher or lower than the selling price. Ne?
Just repeat that again.
If the market value is higher than the selling price, what will you do to arrive at the market value?
You then
Exactly. We are going to add the difference between the market value and the selling price.
Okay.
Ne? So it's not always the case where we are going to subtract.
Oh, okay.
Remember, the determining factor is that these shares are dutiable at their market value. And the set of facts will give you the market value and the selling price. So we know them. Ne? But remember, the shares, you only adjust the value. You don't take it from actual property to deep. They are not deep property, they are actual property. You do your adjustment under actual property. You adjust only the amount so that they are dutiable at their market value. Ask me a question. You are satisfied? There's no way where we cannot include a question with regard to shares in a private company. That is why when you deal with a deceased estate, and the deceased had shares in a private company, it is a must that you must get the valuation of those shares. Always. Because you know that those shares are dutiable at their market value. Even if you decide to sell, but you must still get the valuation of those shares. Section 5.1 FB says nothing about shares in a public company. Don't make an adjustment with regard to shares in a public company. There's a question there?
So it's only the difference that will be deducted in the actual property?
Yes. So our difference in that example will be 10,000, not so. So you reflect the 10,000 in your debit side of your actual property. Because when you minus that 10,000, remember, it is an adjustment on this amount. Ne? Yes. From 70,000, when you minus 10,000, you are left with 60,000. What is 60,000? The market value of the shares. Don't give us the balance. Just show us the difference between the selling price and the market value. Are we fine with the shares? Makes sense, ne? Okay. Now let us look at another adjustment that is provided to us by the Estate Duty Act. It's with regard to the farm. The farm. The farm. Now the Estate Duty Act, ladies and gentlemen, is very kind. it says to us, if the deceased had a farm where there was a farming undertaking on that farm, for the purpose of tax of the estate, for the purpose of estate duty, we are going to reduce the market value. We are going to less 30% on the market value of that farm. It's a good thing because it reduces the chances of the estate having to pay estate duty. If the estate has to pay estate duty, then it reduces that amount. It's a welcome thing. We are going to reduce only 30% on the market value of that farm, only if there was a farming undertaking on that farm. So what does it mean? It means that if this farm was not used for farming, we are not going to reduce it by 30%. We are going to lose that discount. Are we together?
So, which amount do we put there?
We put the 30%, let's say, included. Ne?
Let's say it was 50,000.
Let's make it 60. Okay. That farm was 60,000. So we'll say, what is 30% of 60,000?
Yeah. So that's the amount to put in there.
How much is it? 18,000. You reflect the 18,000. Remember, this is the amount that you are making with regard to your total assets as per the liquidation account. 60,000 is included in that 500,000. So you only reflect the amount that you are reducing, which is 30%. You don't reflect the balance. You reflect the amount that constitutes 30%. Are we together? Yeah.
What if the farming in that?
What if?
What if they were farming in that farm? What if
Yes. That is the reason that we are reducing 30%.
If they were not,
If the farm was not used for farming, we are going to lose 30% discount. We are not going to deduct it. If you deduct it, we are going to mark you wrong. We are telling you now. It's not a secret. Ne?
It's already in the assets.
Ask me, ma'am.
we are saying if there was farming undertaking,
Yes.
you reduce 30% on the market value. If you are not farming, then you put the actual market value of 60,000.
You don't have to put it, already is there.
It's on the, okay.
You don't even reflect it anyway, already is there. Yeah. We only reflect it if you want to reduce it.
Okay.
Because there is a farming undertaking. The second part is that you reduce 30% on the market value. If this property was sold, we also lose the discount of 30%. So it is only on the market value, not on the selling price. If we say the farm was sold, don't come and make an adjustment and reduce it by 30%. Remember, this 30% comes in the estate duty. In the liquidation account, we have reflected the full market value of 60,000. Don't reduce the full market value in the liquidation account by 30%. No. Ne? There you reflect the full value. The full market value in the liquidation account, it is only under the liquidation, it is only under actual property that we are going to reduce by 30%. So read the question carefully. Whether there was, this property was used for residential purposes only or for farming. If the question says it was used for residential purposes, don't reduce it by 30%. In other words, don't say, there's a farm, I reduce 30%. Read the question carefully. You got me, ne? Eta. Ne? If there is a farm, and then we say, this farm was sold during the course of liquidation, we are not going to make this adjustment. Does it make sense? Yeah. Wonderful. Therefore, you don't take this farm to deem property. Please don't do that. You only make the adjustment under actual property. You are barely adjusting the value for the purpose of estate duty. Are we together? Any question? This is the maximum of the adjustments that you can make under actual property. Pardon? Any one of them has to come in the question paper. Ne? Even if you put the farm, but now you know how to deal with it. Whether you'll make an adjustment or not, it's very straightforward.
Just a clarity on the policy again. So the surrender value does not come on the estate duty, only the matured policy.
Yes, yes. And let me make it more harder and say, when you come to the calculation of estate duty, ne, don't think of a surrender policy at all.
Only the matured.
Ne? If your man says, but surrender, stop it there and say, no, not surrender. Refuse with thinking about surrender value when you come to making the adjustments. Are we together, ladies and gentlemen? Good.